Okay, so the supplementary leverage ratio, or SLR, is an alternative way of measuring the amount of capital that a bank has relative to its assets. The traditional way to do it is called risk-based capital requirement, which adjusts the assets for their risk and requires capital based on the risk-adjusted amount of assets. Whereas the supplementary leverage ratio doesn't adjust for risk. It just adds up all the assets and requires the bank to hold a given fraction of those unadjusted assets. So in the United States, the largest banks are subject to a 6% supplementary leverage ratio under the Fed's interpretation of this requirement, which means for every $100 of assets on its balance sheet, regardless of the risk, it needs to have $6 of capital. That would be the same whether it was risky real estate loans, or treasury securities, or central bank deposits. The implication is that banks are much less interested now in intermediating safe assets as they were before, because they have to have the same amount of capital for safe assets as risky assets, and the profits associated with intermediating safe assets for their shareholders are much smaller. So what we're seeing in practice is a shift away from activities like government securities repurchase agreements, or repo, as an intermediation business, because it uses up a lot of balance sheet with respect to the supplementary leverage ratio, and there's not enough juice in it in terms of shareholder returns. Okay, so people have asked me, well, if you're not a fan of the supplementary leverage ratio, how do you propose to get the right amount of capital into banks? And a common concern is that the risk-based capital requirements are mismeasured, because banks use internal models to measure their risk, and the banks have an incentive to understate their risks for that reason. The regulators need to react by being more conservative with respect to the kinds of internal modeling that they allow the banks to use. The regulators themselves are a bit at fault because they don't assign any risk weights to government securities. Governments are usually easy on themselves, and they're loath to criticize each other for the quality of their government securities, so most government securities don't require any capital. So whether it's the banks understating their risks or the regulators not assigning risk weights to government securities, the risk-weighted requirements also have a problem. The supplementary leverage ratio was brought in as a backstop, just in case the risk weights didn't work. But if you look at the numbers, and I have, it's the supplementary leverage ratio that's the binding constraint, and the risk-weighted requirements are just a backstop the way things are now. We need to flip that around. So either you need to increase the risk-weighted requirements or reduce the supplementary leverage ratio. The problem with the latter is that bank capital goes down, and in my view, it's not too high. One could adjust the supplementary leverage ratio and selectively so that it doesn't lean so hard on the safest assets, like Treasury repo. And in the last report from the Department of Treasury, the so-called executive orders report on reforming the financial regulations, they did hint that they may do this, and so have some leaders at the Fed suggest that they need to look further into whether the supplementary leverage ratio is working properly. So I do expect some adjustments in that area. Another thing you could do, if you're really convinced that the supplementary leverage ratio is the right way to go, is to calculate how much capital there should be in the entire banking system based on the supplementary leverage ratio, but don't apply it to each individual bank. Just increase the risk-weighted requirements until you get that amount of capital into the banking system, so that each bank will then adjust its market making and other activities according to the risk-weighted requirements. but that you have enough capital in the system according to the supplementary leverage ratio. And I've made that suggestion in my Duffie lecture to the Bank of Italy as another way to get at this problem. I agree with that. There's always going to be some give and take, and these capital regulations are always crude approaches to making the banks safer. So when you're uncertain about whether these requirements are working well, the natural reaction should be to raise overall capital levels in the banking system to guard against any problems. The banks don't like that because their shareholders lose money when you raise capital. It tends to increase the value of the bank's debt, and therefore it has to reduce the value of the bank's equity. It's called debt overhang. But again, this is an issue of safety and soundness of the financial system. The regulators shouldn't be shy. I noticed that the pendulum has been swinging back towards lighter capital requirements in the latest rounds of discussion, both in Europe and the United States, and I think that's a mistake. I think capital levels are not too low, are not too high.